Okay. Okay, good afternoon, everybody. I think many of you know me. I'm also familiar with many of you. I remember I came here in May, and then I said I would come again in during October because of this Shanghai Hong Kong Stock Connect. And last time, when I came, I talked about how we can explore investment opportunities, find some stocks that will benefit from the launch of this program, this pilot program, the tie-up between Shanghai and Hong Kong. Last time, I test your memory. Did I recommend any stock, specific stock? Yes. What is that? 1599 is good lah. Is engage in the design of underground trains in China, but that one is not actually directly related to the Hong Kong Stock Connect. It's not a beneficiary, but we are optimistic about the long-term outlook because last time I mentioned there are more than 40 cities in China that have plans to build underground trains. So this company 1599, I think when I recommend it, it's about below $4. Yeah, now it went up to 550, about $5. So just within 4 months time, performance is very good lah. But last time, still, I want to test you. What's the stock I recommend that will benefit from 388 Hong Kong EX? Because the stock universe, the stocks that may attract the attention of Chinese investors the universe is quite wide lah. So we narrow down just pick one stock that will certainly benefit from this program and that we think is Hong Kong EX 388. The time we recommended last time, I think the share price was around 140 Hong Kong dollars. And then it went up to 185 highest early September. Of course, during over the last month, the market corrects and then the share price came back to about $170, 170, but it's still higher, much higher than the recommended price, the price we recommended. So today, you notice I will talk about more about this Shanghai Hong Kong Connect because it's coming real this time. Last time I give you a timeline of the chronologies of this program. It was announced in early April. So after the announcement, the market shot up. It's definitely seen as a positive to the Hong Kong market. The market shot up. And then May I came is a good timing because after the excitement calms down, the market corrected and the Hang Seng Index dropped back to around 23,000 after the announcement. And then subsequently, it started to rise to as high as 25,350. That was this year's high for the Hong Kong Hang Seng Index seen in early September. Okay. Now update you on this program. They are late last weekend. They had done the second largest technology, not second technology test on the program. So there's one more technology test this weekend. If everything goes well after this last technology test, then the expected launch date of Hong Kong Stock Connect, Shanghai Hong Kong Stock Connect will be the 27th of October. So this is the date that you have to take note of. It's expected launch date. I would say expected launch date but maybe something they have disclosed because I was in KL on Friday. I came down from KL, so I had not read the latest news on the Hong Kong EX. If there's no new announcement, the expected date would be the 27th of October. Why they haven't fixed it yet? Because it depends on the technology test. They don't want to screw up, so they have to conduct all the technology tests, satisfy all the requirements before they announce the actual launch date. But now it's very much expected to be 27th October. Last time, this title is quite similar to my last one. Last one was explore new investment opportunities in Hong Kong. Because at that time, this time, you notice I put in China. Because last time, you can only buy Hong Kong shares before this program. Always, we can only, if you invest in Hong Kong, you can invest only in Hong Kong X shares, not the A share. Now they're going to open up. So now this time round, I give you more details about the China market. So in case in future you want to recommend some Chinese companies listed on the Shanghai exchange, this is quite different from what we are doing in the past. Now we can recommend A shares to our clients. Okay. Some background information about Shanghai Hong Kong Stock Connect in case you don't know what it is. It provides mutual stock market access between Hong Kong and Shanghai. So it's a two-way opening up of the capital market. Still, Chinese investors are not allowed to invest in overseas market, including Hong Kong market. But under this Shanghai Hong Kong Stock Connect scheme, they can invest in certain stocks listed in Hong Kong. So Hong Kong will benefit. Why we recommend Hong Kong EX? Because we believe that with more Chinese investors investing in Hong Kong, the market turnover will benefit. It will increase the market turnover. Okay, you have to take note of not all the stocks are eligible for investment. So for northbound trading, northbound means from Hong Kong to Shanghai. Also applies to you, to all the foreign investors. It includes all the constituent stocks of the SSE 180. SSE stands for Shanghai Stock Exchange, Shanghai. 交易所 and SSE 380 index and all the SSE listed A shares that are not included as constituent stocks of the two indexes but which have already X shares listed in Hong Kong. So I would give you the exact number of how many eligible stocks you can invest in the A share market. For southbound trading, that means for mainland Chinese who can invest in Hong Kong, the number of eligible stocks are much smaller. Only the constituent stocks of the Hang Seng Composite Large Cap Index and also the Mid Cap Index and all X shares that are not included as constituent stocks of these two indexes, but which have correspondent shares listed as A share in Shanghai. So you can see that they want to limit the stocks, the company to big cap, large cap, and mid cap companies, not the penny stocks. They don't want the investors to get involved with penny stocks, the speculative one. So the investment universe, this is the investment universe that you have to take note of. So for Shanghai, so going forward, you can invest in 180, 380. So total number of 180 plus add up together is 560, right? Because this one have 180 constituent stocks. This one have 380 constituent stocks. So it is known as 180 and 380. Add up together is 560. Then here number of stocks 568. How come it's 568? Because there are 8 companies that do not belong to 180 and 380, but they already have shares listed in Hong Kong as X shares. So altogether 568. In terms of number of stocks, the weighting compared to the Shanghai market, it accounts for 50. This group of stocks account for 59% of the total market, Shanghai market, and the average PE. Very cheap because I understand Singapore now the average PE is 16 times, I presume, and China is trading the blue chip and also the mid-cap companies. They are trading on 9 times average PE. Market cap, wow, is quite huge of these 500 odd stocks, 13 trillion yuan. In terms of market cap, it accounts for nearly 90% of the total market. So these are big cap and mid cap companies. For Hong Kong stocks, mainland Chinese, they can invest only in 266 companies. Those are constituents of the two indexes, the large cap index and the mid cap index, and also some stocks that are not included in the two indexes, but they have correspondent shares listed in Hong Kong as X shares. So altogether 266. In terms of number of stocks, it only accounts for 18% of the market. But in terms of market cap, it accounts for more than 80% of the total market. Okay. So I explained a little bit about the Shanghai indexes. There's a series of indexes. They have many indexes. This one is the most widely reported and most widely used. It's just like China's Dow Jones, because this is Shanghai 综合指数, Shanghai Stock Exchange Composite Index. Now is around 2,350 it is an index of all the stocks listed in Shanghai Exchange. It's not, they don't have constituent stocks, selected constituent stocks. They add up all the stock listed on the Shanghai market to compile the composite index. So it's a reflection of the broad market, how the broad market perform. Okay. And it is the oldest index, the first index in the China stock market. It was launched in 1991. Okay. SSE 180 index. In future, if you want to check the index level, you can search by the index code. It's the same code with Shanghai stock number, stock code. They have six digit for Shanghai. In future, any I think you may be aware of that. Any set of numbers start with the digit 6000, whatever. They represent stocks listed in Shanghai. In Shenzhen, for stocks listed in Shenzhen, the first digit would be 0. So by looking at the first digit of the index or the stock code in China, they use 6-digit stock code. You will tell whether it's a Shanghai stock or Shenzhen stock. So first thing, under this scheme, you can only invest, foreign investors can only invest in Shanghai A shares only. Shenzhen not included. You have to wait. When your client asks you what kind of companies are eligible, Shanghai companies, but 568 companies in total. Okay. This index reflect the complete picture of those good quality large enterprises, the blue cap companies. So I'll share with you how they select the constituent stocks. So you can have an understanding of the selection method. It's chosen at first. They rank all the stocks by means of two criteria, two parameters. That is the total market capitalization and the trading value. The largest, the market cap, if you are the largest, you have a higher ranking. It's that simple. And then they allocate number of constituents for each industry based on free float adjustment market capitalization coverage. They also look at the industry. Every industry, they give a weighting to different industry. Say for instance, financial, they decide the weighting is 5 stocks. Then they will take among the financial companies, those with the highest market cap and also the highest trading value with the high ranking. They will just choose 5 because for the financial industry, only 5 stocks are chosen. You understand? So they also look at the industry classification. Okay, 380, the index code will be 00009. It consists of 380 stocks with mid-cap, high growth, and good earning record. It aims to reflect the performance of the Shanghai new blue chip stock. So a differentiation major difference between 180 and 380 is 180 can be described as the old blue chip stocks. As for 380, they can be described as new blue chip stocks, the faster growing companies. Okay, how the stock universe for 380? This is the 380 stock universe. They will exclude stocks that are constituents of SSE 180. That means there's no overlapping of stocks. Once you are 180, you won't be constituent stocks of SSE 380. And then they exclude companies that the retained profit after appropriation is less than 0. That means all the loss-making company would not be eligible to be constituents of 380, SSE 380. So investors can be better assured that these companies are profit-making company. But this is, of course, history. Whether they can remain profitable is another issue. But at least they only choose companies that make profits. And then also companies that pay dividend in the past 5 years. If the company don't pay dividend in the past 5 years, they would be excluded from the SSE 380. Okay? How they rank it? is more or less the same with 180, but they add into more perimeter. That is the income growth rate. They look at the sales growth rate. Higher, you get a higher ranking. And then they also look at the ROE. In addition to market capitalization and trading volume values. So the ranking of S80 stocks, they use 4 perimeter: market capitalization, trading value, income growth rate, and ROE. And then they also allocate number of constituents for each industry using the same method. And they will select top ranking stocks within each industry based on the number of constituents allocated. Okay. What are the 10, okay, before I talk about the industry classification, this is one thing you need to remember, the periodical review. So constituents are reviewed every 6 months, and there will be a committee, the SSE Index Advisory Committee. They will hold meetings twice a year, usually in early June and early December. And then they will decide whether there's any adjustment, any change to the index, to the constituent stocks. And then if there's any change, the implementation will come on the first trading day of July and January. So every year, when there's a adjustment, you have to take note of. And to avoid too much volatility, they will not the adjustment of each periodical review will not exceed 10%. So they won't change more than 10% of the constituent stocks. There's one question, frequently asked question you may wish to ask is if your client buy a stock, now is constituent stocks. Then after the review, is removed from the index, no longer a constituent stock. So what will happen? My understanding, they have not actually clarify, but the understanding is you can still keep the stock. There's no urge for you to sell it if there's is it removed from the, but for investors, after the adjustment, they cannot buy the stock again because it's no more eligible. You can keep it and sell when as you like, but you cannot buy again because it's no longer a constituent stocks. Okay. So industry classification is classified into 10 industries based on international prevailing industry classification standard. They use Morgan Stanley and S&P method of industry classification, but some adjustment have been made to adapt to the characteristics of listed companies in China. Okay. These are the industry classification for companies listed in China. You have the energy, materials, industrials, consumer discretionary, consumer staples, healthcare, financials, information technology, telecommunication services, and utilities. Okay. So SE180 index, as I mentioned just now, is a representation of the old economy, the 旧经济, because most of the companies falls under these 4 industries, financials, namely financial, energy, materials, and industrial. So these are the old economy stocks. Okay. As for the 380 index, most of the companies, the constituents, fall under the new economy, such as power conservation, environmental protection, information, IT, biotech, new energy, new materials, and high-end equipment. Okay, so I've explained to you the major difference between 180 and 380. If you are going to advise to your customer only to choose between 180 and 380, which one will you recommend? 380. Is that a good choice? Let's look at this. I test you. This purple one, clearly outperformer. Here is a relative performance of 3 indexes, namely the SSE 180, SSE 380, and the broad market, the Shanghai Composite Index. So clearly here, you can see 380 is the clear outperformer. This is starting from January. So except for a few months that have recorded negative return for the 380 indexes, for the rest of the year, you see, it registered positive return, and starting from July, you see the sharp rally here. So 380 is doing better than the broad market and also 180. This is 180. The blue line represents the SSE 180 because they are blue chips. Blue chips tend to move more slowly, but whether they are more defensive is not really so, because during most of the time they recorded negative return. That means even if you buy the blue chips, you don't you make a loss, while other stocks are already making gains. But what I suggest is you can actually construct a portfolio for yourself or for your customers, including 180 and 380. Not just, you can have a diversified portfolio. Okay. If you want to learn more about the index and also the constituent stocks, because there are altogether 500 companies, I cannot brief with you one by one. So you can go to this website. This is the official website of the Shanghai Stock Exchange. There is both Chinese and English, so it's a bilingual website. The information is very comprehensive. You can check out the constituent list, and if you click on the name of the company, you can also get the information, company information of individual company, and also the financial statement. So you can do your own research analysis in future by going to this website. Okay. Last time, in addition to Hong Kong EX, we also recommend one method, one way to capitalize on the this upcoming Shanghai Hong Kong stock program. That is to look at those X shares that are listed in Hong Kong and with corresponding shares on the A market, but the price are different. There's a price difference. And for those X shares which are trading at a deep discount to the A share, so it's very likely that after this program is launched, the share price will converge gradually, because they're the same company trading at different price level in China and Hong Kong. So after this, but arbitraging is still not allowed. By means of arbitraging, that means you cannot buy in Hong Kong and move the shares to China to settle. If you sell in China, you move the shares through the register and settle in China. No, you cannot do that yet. But you can buy in Hong Kong, hold it in Hong Kong, and sell your shares in China for mainland Chinese. So by doing so, the share price will somehow converge, but not very quickly. Because if you do, there is a arbitrage. The convergence will happen very quickly. Price difference will narrow. But this one will not, because they still don't allow the transfer of shares between the two exchanges. Now I think you can try to capitalize from two ways. Because there are companies trading as X shares. If the X shares, the share price is lower than the A share, then you should buy the cheaper one. And if the share price of the A shares in Shanghai is cheaper than the X shares, then you should buy in the A share market. One thing I actually we are going to recommend our customers, because many of our customers are already holding some X shares, Hong Kong X shares, and then you look at whether those X shares are trading at a premium to the corresponding A shares. If that's so, and if the premium is big enough, justify a switch. You tell the client to sell the X shares and then buy the A share. Because that one, no difference to their shareholding. They still hold the same company. They will receive the same dividend. But by doing so, they can, because the share price 10% or more cheaper, so they get a discount on the investment. And okay, so out of the 68, there are altogether 68 companies with both A and X shares listed in Hong Kong and Shanghai. This I only include Shanghai. There will be more companies listed with A and X shares in Shenzhen, more than that, more than 68. But here we only look at A and X shares Hong Kong and Shanghai because Shenzhen will not apply to Shenzhen. The H shares of about 24 companies are trading at a premium to their corresponding A shares. So for these 24 companies, we should not hold the H shares. We should hold the A share. And for the remaining 48 companies, the H shares are trading at a discount to the corresponding A shares. There's a high chance that the share price of these 48 companies will rise more substantially than the A share to converge to the share price of the A shares. Okay. Because there's a long list, I can't show you again 68 all the 68 companies. So I just show you top 10 H share and top 10 A share that they're trading at a big premium, the biggest premium. So Qingdao Brewery, Qingdao 啤酒, the H share is 11% more expensive than the A share. Okay. Then Huaneng Power is one of the 5 largest power company in China. Huaneng Dianli. Anhui Conch is the largest cement maker. Anhui Hailuo in China. Ping An is the second largest life insurance company in China. China Pacific Taipingyang Baoxian is the third largest insurance company in China. Huadian Power is also one of the 5 largest power companies in China. China Senhua is the largest coal mining company, Zhongguo Shenhua. And ICBC is the largest state-owned commercial bank. This is Gongshang Yinhang. And agricultural bank is Longye Yinhang and China Life, Zhongguo Renshou. All these 10 companies, their H shares are trading more than 10% higher than the A share. So I think many of your customers, they may be holding these stocks because they are very popular stocks in Hong Kong. Chinese companies are very popular one. Out of the 10, you notice there's a distinctive feature, very distinctive is 5 companies belong to the financial sector. Yeah, Ping An, China Pacific, ICBC, Agricultural Bank, and China Life. Actually, most of the state-owned banks, they are all trading. The H shares are trading at the premium to the A share. That means they are more. The valuation in Hong Kong is higher than the valuation in China. Why is it so? It shows the preference, the different preference of investors in Hong Kong and China. Hong Kong investors, they are, in a sense, more rational lah. They are more defensive lah. No offense to Chinese investors, but if you look at the second chart, you notice the irrationality of the Chinese investors. So they want a more defensive place. But in China, it is known that they don't like financial stocks very much. Because financial stocks, market cap are very huge, so it's not very volatile. They like the more volatile stocks. Okay. The second chart shows you top 10 A share. They are trading at premium to the H shares. You see here, same company. In China, the A share is 1.4 times more expensive than the company in H share. So either one must be, either Hong Kong investors are too stupid, they don't realize the investment value of these companies, or either Chinese investors are too naive or too optimistic that they are willing to pay such a high valuation. So these companies, you may, food for thought that over time their share price may converge. That means the H shares may rise more, so that the premium will come down. But one thing I need to remind you is most of the companies here are loss-making companies, and that's why that's why Hong Kong, the H shares are trading so low, because Hong Kong investors, as I mentioned, are more rational. So they don't want to, they will not give a high valuation to loss-making company. But like Chongqing Iron, the iron steel manufacturers, all of them are losing money, are loss-making because of oversupply. But there are some good companies, like for instance, this China Molybdenum. Its first half earnings have grew, I think, 2-3 times from year on year. Molybdenum is used in stainless steel manufacturing. They add the molybdenum into the iron and steel to make it more harder and also less vulnerable to rust. So and out of these 10 stocks, our portfolio, we manage for our clients. There's one stock in our portfolio, and there is Dalian Port. Dalian Port is the largest port operator that handle dry bulk in northern China. So dry bulk includes coal, iron ore, and grain, agricultural products. So China still import a lot of coal and iron ore from outside. So most of the shipment goes through Dalian Port, and it's only trading at 12 to 13 times PE, and the share price is 80%. A share is 80% more expensive than X share. So this one we have this one in our portfolio. Okay. Hong Kong EX review update on Hong Kong EX, how it's doing. So last time we stated that it will be the major beneficiary of the Stock Connect program, because Hong Kong EX together with SSE, Hong Kong SCC, and China Clear will share all the revenue equally. So if there's an increase of revenue, Hong Kong EX, actually this HKSCC stands for Securities Clearing Company. It's the clearing house of it's owned by Hong Kong EX. So it will benefit from more trading, more clearing, more revenue in future. It's estimated that if the daily quota are fully used up for the southbound trading, there will be a daily quota for both sides. That means it's about 15 billion Hong Kong dollars a day. So currently the market turnover in Hong Kong, I think it's about 4 to 5 times your daily market turnover. Now is between 60 billion to 70 billion a day. So if the daily quota is used up, fully used up, it will increase our daily market turnover by 19%, by close to 20%. And then it is reported that this is only a pilot program. If the program goes on well, they will increase the daily quota, like they increase the Q fee and RQ fee. So there will be more trading, more going forward. Okay, first half results are not very impressive, because in the first half, the Hong Kong market was very sluggish. So trading in securities dropped 8%. The securities market in the first half of 2014, trading in derivatives dropped less, but still dropped 6% in the first half. Yet Hong Kong EX, the revenue increased 4% despite the drop in the transaction. Revenue increased to 4.62 billion, and profit attributable to shareholders increased 2% to 2.36 billion. And then for Hong Kong EX, one impetus would be IPO. I think if you follow the Hong Kong market, the IPO market have become quite active recently. IPO funds raised in the first half doubled the amount raised in the same period last year. That's only for the first half. Third quarter, we have also a very good third quarter. And many of the IPOs recently, I talked to Mr. Low just now, some of his clients make profit from the IPOs in Hong Kong. Many of them, the share price rose after the listing. Okay. And out of the 4 largest IPOs in Asia in the last 9 months, 3 are in Hong Kong. Okay, but unfortunately, we lost one, Alibaba, to the US. But we are happy with that, because you know why we lost to MISC is because the associate system, they have this. Jack Ma want to insist that despite if in future they don't have majority holding of the stock, because they have this the founding team of the company will still control the management of the company, and the Hong Kong regulator thinks this is not fair to minority shareholders. If you are not doing well, majority shareholder cannot oust the management. So what is the check and balance? There's no check and balance. Okay. For Hong Kong EX, I don't know if you are aware, Hong Kong EX has actually acquired LME, London Metal Stock Exchange, in 2012. So LME was doing quite well in the first half this year. average daily volume was up 3% compared to the same period last year and 10% higher than the second half last year. Average on now this would be another impetus because when Hong Kong EX acquire LME in 2012, they make a promise to all the members, all the fees will be frozen for 2 years. So now this lockup, this is going to expire end of this year. And then they have announced actually recently that average transaction fee for LME's trading will increase by 34% effective from 1st January 2015. So we have calculated an increase of transaction fee by 34% on the LME using the number of trades done last year. It will boost Hong Kong EX revenue by about 5%, at least 5%. So 5% more revenue contribution from LME next year. Okay, but that is based on the transaction volume last year. If transaction volume next year is higher, then the boost will be bigger. And then they have migrated the clearing for LME. In the past, LME clearing was not within LME. It was done by another external party. Now they migrated it to a new clearing house developed by LME Clear that is owned by LME. So it will provide a new revenue stream. They earn the clearing fees. LME will earn the clearing fees. That means LME as a subsidiary of Hong Kong EX will benefit. So and it will also be beneficial in future when LME launch new products because the clearing house is a subsidiary, so they can work more closely with the clearing house on the launch of new products, on the introduction of new products. Okay, this one may happen, may materialize in future, and that is for the LME to replicate the Stock Connect, because now this tie-up between Hong Kong and China only applies to stock trading between Hong Kong and China. Commodities trading is not tied up yet. So, but the Chief Executive of the Hong Kong EX, Charles Lee, he stated that he hoped that the Shanghai Hong Kong Connect model can be replicated and the system will be used as a blueprint for future opening up of commodities trading to mainland traders through the Hong Kong market. I think we all know that mainland traders are getting more and more influential in the international commodity exchanges, CME and LME. So many of them are end users of commodities. So if there's a commodity connect between LME and China, it will benefit LME and also subsequently it will benefit Hong Kong EX. Okay. Oh, as I mentioned just now, this Stock Connect only applies to Shanghai. So what happened to Shenzhen? Shenzhen will definitely not be left out lah. It's only a matter of time. They want to do it step by step. So they want to do it first for Shanghai, and after that would be Shenzhen. The Shenzhen Hong Kong Stock Connect is also underway, and it's expected to be launched next year. So Hong Kong EX will benefit more if Shenzhen is connected. Okay. So this is the price chart of Hong Kong EX. That was when they announced the the Shanghai Hong Kong Stock Connect. So it was regarded as a positive factor for the Hong Kong EX. So the share price kept up, shot up after the announcement, and then it came down. I think I came to Singapore in May. The share price was around 140. That time we recommend this stock. It's a blue chip company. It's also a constituent stock of the Hang Seng index, blue chip index. So it's big and it's defensive and safe. And then its share price rally from 140, below 140 to 185. After topping at 185, it corrected with the broad market. So it dropped to 162 at the time, early October. Then there was a very strong rebound. So the rebound of Hong Kong EX is actually much stronger than the broad market. I think it's because it's supported by positive factor such as the Stock Connect between Shanghai and Hong Kong. So we still regard it, will rate it as a buy. If you are holding it, you can still hold it, and if you have not, you can buy. The recommended entry price would be around 165 to 168, 165, 168 Hong Kong dollars. And our new target for last time, I remember our target is only 170. Bonus would be 180. So it has actually overshot. We have exceeded our target. This time round, we have upwardly revised our target to 190. 190 would be our new target. So recommended entry price would be between 165 and 168. Stop loss, to play safe, you need to put a stop loss. Stop loss would be, we recommend the stop loss at 150. 150. So it's about 10% downside if you stop loss at one. Unfortunately, need to stop loss. Okay. Okay, market outlook. It's strange that nobody asked me in Singapore yet about this Occupy Hong Kong, how it will affect the Hong Kong market or affect Hong Kong economy. I came down from KL, so many investors there asked me about Occupy Hong Kong. If you have visited our office in Hong Kong, our head office is in Admiralty, in United Center, which is at the center of the demonstration. Because they occupy, first they don't occupy it's called Occupy Central, the movement called Occupy Central. But actually they don't occupy Central first. The place they occupied first was Admiralty. Because the headquarters of the government headquarters was located in Admiralty, just very near our head office. But you ask me, I go to work every day. Actually, there's not much disruption to me because I live very near the office. I go to office on foot I walk to the office. So some bus routes to be fair, many of the bus routes on the Hong Kong Island and also the tram there's tram service in Hong Kong are rerouted. So there's no bus going into Admiralty and Central, but the MTR, your MRT equivalent to your MRT, the MTR operation is not affected, so it remains normal, and people actually use MTR more to go to work. And some people, especially the central, the white collar working in central, actually they are quite happy about this Occupy movement, because no buses, no cars going to Central and Admiralty. Their air quality is the best in 20 years. Best quality in Mong Kok, Tsim Sha Tsui, which used to be the most polluted area. And also many of the central dwellers, I would say central dwellers, and Causeway Bay, Tsim Sha Tsui dwellers, they are more happier because in the past there are so many 自由行, 自由行, mainland visitors, so crowded, 普通话 speaking, we are still very much a Cantonese speaking population, so a little bit hostile, regarding 普通话 So now they feel better. But how this will end, I really don't have any answer, because this is entering the 16th day of demonstration. So the demonstration started on the 27th and 28th of September. Why is so widely reported and become so scary? Outsiders may think Hong Kong is a very dangerous place, more dangerous than Iraq and and Ukraine. So dare not go to Hong Kong. And many countries, I also noticed, Italy, Australia, they have issued travel warning on Hong Kong. But actually, it's not really that dangerous, only because I think it's a very personal view. The Hong Kong government has made a mistake, a wrong decision by using tear gas on the 28th of September. I think that's related to the National Day on the 1st of October. So the Hong Kong government at that time, they noticed that the crowd was getting bigger. So they thought by using tear gas can disperse the people, so people will go home. But this backfire. Actually, on the contrary, it attracted more people. It enraged a lot of the Hong Kong people. So Hong Kong people, those who are the quiet ones, they took on they went to the street as a demonstration of their anger because the Hong Kong government, the police used 87. They have lashed 87 tear gas bombs on the Hong Kong people, their own people. So, but after that, the Hong Kong government was very constrained. And they play softball to the demonstrator, a delaying tactic. So now it's like playing 民意啦. More and more people are unhappy lah, to be fair. Those who are affected by the occupying, the retailers, and some workers who need to spend more time traveling to work and back home. So there is a new opposition coming up. I think it is a delaying tactic. It will wear out. Then to me, I think it's let's get back to investment opportunity. It's an opportunity, investment opportunity for us, for foreign investors, because but we will recommend for the time being, avoid the local companies, because some of the local companies will inevitably be affected by the occupying movement, such as retailers, Zhou Daifuk, Zhou Tafu, the Luk Fuk, the jewelry shops, and also Sasa will be affected, so the retailers, and also the property investment companies such as Wharf and Swire Pacific that own the shopping malls, because maybe there will be less footfall, less customers going to the shopping malls. And also property developers is uncertain. I won't say there would be a big impact on the property market. It's not known yet whether this occupying movement just into the 16th day, whether it will affect people buying property in Hong Kong. I would not say it's not certain, it's still uncertain. But to play safe, avoid the sector for the time being. And then local banks may also got hit because they will be slower if the property market is affected. Less transaction on the property market, that means less demand for loan, housing loans, and also commercial trade loans will maybe also be affected. But a lot of the Chinese companies listed Hong Kong, don't forget now we have more and more Chinese companies listed in Hong Kong. Actually, their business operations are all in China. They will be, by no means, their business operation will be affected by the occupying movement. But the share price, many of the share price have come down 10%. The market has corrected 10% from a recent high. So there's no change to the business, the fundamental of those companies. And I see no reason why after the incident, the ending of the movement, I think that the stocks that will rebound most quickly would be those that are less or totally not affected by the Occupy movement, and those will be the Chinese companies, the profitable ones, of course, the good ones. Okay. Here, I show you the relative performance of all the Asian markets year to date. So you see here, this is a little bit difficult to see. I have a table here. Year to date, India still ranked number one, up 24% year to date, followed by the Philippines, Vietnam, and Thailand. China has actually caught up quite impressively because in the first half, China was still down by 0.5%. China was still down. Now, up year to date, China, the CSI 300. This is different from Shanghai Composite Index. Here, I don't use Shanghai Composite Index. I use Husen Sanbai. Husen also includes the Shenzhen market. So it's more a better representation, reflection of the whole China market. It was up 5.2% year to date. But for Hong Kong, because it's affected by the U.S. market correction and also by this occupying movement, so it was only the Hang Seng Index was only up 0.5% year to date. Your Straits Times, I think, is only up 2.4%. China, better in the year to date. But if you look at the third quarter, this yellow line, this one is the CSI 300. Wow. China finally catching up. So in the third quarter, the CSI 300 was up 13.2%. The brightest, strongest market globally, not only in Asia, but also in the world, the best performing market. And then followed by Thailand, Japan, the Philippines. Hong Kong was down 1% in the third quarter. Okay. A little update on the China, the macroeconomic side. So actually, you heard about the slowdown. Yes, the economy is still heading for a slowdown, but the third quarter GDP is expected to be to slow down to 7.3%, 7.3%. But if you compare to ASEAN and India, ASEAN is about 6% the GDP growth. India is about five something less than 6% GDP growth. So China's GDP growth actually is still higher than ASEAN and India. The biggest worry is there's a hard landing, that it will drop very drastically. But over last 9 months, our observation shows that the Chinese government is actually quite alert about the slowdown. So they have actually implemented stimulus measures, which I will talk about, stimulus measures to prop up the economy. So they won't let the economy to slow down, say below 7%. So anything about the GDP growth about 7% is acceptable, still acceptable. If you look at the PMI, because the GDP was historical figures, leading indicator, the leading barometer will be the Purchasing Manager Index. Anything above 50 means the economy is still expanding. If it drops below 50, that means it has entered contraction mode. The official PMI is quite healthy. So far, since last 2 years, the PMI, official PMI remain about 50. That's the threshold between expansion and contraction. But the HSBC PMI is a bit more choppy, more volatile, sometimes above 50, sometimes below 50. Why is there a difference between the two PMI? It's because the survey, the PMIs, the purchasing managers, the survey are different. HSBC, they survey most of the interviewees, the purchasing managers are from small and mid-cap companies. So, but this one, most of the interviewees come from state-owned companies. So state-owned companies they tend to have better support from the state. So the PM, the purchasing managers tend to be more optimistic and confident regarding the future. But even for HSBC PMI, for the last 3 months, after rising back to 50, it has been about 50 for, I think, 4 months, consecutive months, 4 months in a row. Okay. So if China is going to implement some stimulus measure, it's believed that now U.S. Will end the bond purchasing program this month, and then interest rate may set to rise next year. It is believed, widely believed, that when U.S. Stop the QE, China will start easing, because they don't want to do easing together along with the U.S. in case it will bring too much hot money to China and also cause the overheating to get worse. Now with U.S. stopping, ceasing the QE, there's a chance for China to do further easing. And the CPI, this is one key factor which will restrict the Chinese government from easing. Now, actually, I heard that ASEAN, the inflation rate is quite high. Inflation rate 5% as well. 6% GDP growth, but inflation also 5%. But China, the CPI, latest CPI has dropped below 2%. Actually, it remained below 3% for the last one year or so. So inflation has moderated very substantially in China. So if the central bank, People's Bank of China, wants to cut interest rate or do monetary easing, I think inflation will be less concern as compared to other countries. Okay. The Chinese government has actually adopted some mini stimulus. They call mini stimulus, 微刺激, because they have learned the lesson in 2008. The 4 trillion stimulus package has caused a lot of side effects, such as oversupply to get worse and also overheating in the property market. Now they will only adopt mini stimulus and targeted easing, 定向宽松. That means easing only towards certain selected sectors, not across the board one. The measures are namely loosening credit for rural banks, so they want to support the farmer, the rural community, expanding loans to smaller borrowers. They know it's very hard for small and mid-cap companies to get bank loans, so they expand loans to smaller borrowers and reduce fees and taxes for businesses. Most importantly, they have recently eased mortgage lending rules. There are a total of 46 cities in China that have imposed restriction on property purchase. That means most cities, they only allow each household to buy one property. But now 42 cities have relaxed this restriction. That means because for a while, the market was worried about a burst of the bubble, the property bubble. But now by the signs that the Chinese government is relaxing the property restriction, that means they feel that the property market has actually achieved a soft landing. Now property prices, instead of keep on rising, actually has started to decline. And property price, if it drops too much, it will affect a lot of consequences or adverse impacts on the provincial finance, because a lot of the provincial government, they derive their income not from taxes, because in China a lot of evasion of taxes, people pay very little tax. So provincial government get their financing, the revenue from land sales. If the property market was so bad that property developers cut down, reduce their land acquisition, it will affect the financial position of many provincial government. So the central government doesn't want this to happen. So now you see relaxation on 42 on property control. That means the market is a indication that the property market has achieved a soft landing. Now they want to prop it up again. Okay. It's very likely that there will be interest rate cuts and also RRR cuts going forward. What is meant by RRR is a short abbreviated form of reserve requirement ratio. That is the deposits, the percentage of deposit commercial banks has to keep with the central bank. So now it's 20%. I think it's the highest in the world, 20% RRR requirement ratio. That means for every $100 deposit you receive from the depositor, you have to put $20 with the central bank. You cannot lend out the $20. And you got no interest from the central bank. You have to keep the money with the reserve with the central bank, no interest, not interest bearing. And then there is also the loans to deposit ratio. Currently in China, the loans to deposit ratio is 75%. So that means every $100 deposit, you only get $80 with the bank. And $80, you can only lend up to 75% of the $80. So this is one way how they are going to control lending growth. Because lending growth is seen to be the cause of the overheating. And interest rate is still very high. Official interest rate is about 6% now. But for a lot of small companies, the actual funding cost for them is 8 to 10%. 8 to 10% is very, very high. Your ROE is less than that. So if they cut interest rate, that will help ease the burden on many small and mid-cap companies. Okay. Leading PE band of Shanghai Composite Index are very cheap. Now it's about nine times. The fair value for I think it's very much the same with Singapore, Thailand, and other, and even S&P. 16 times is the fair value. So now we are still only 9 times PE for the Shanghai stock market. Our target for CSI 300, 12-month target. This is 12-month target. So actually, you see the index was moving sideways for the last 2-3 years, but you see notice a rally starting to climb since July this year. The CSI now was trading at 2,450. Our 12-month target is 2,800. That means another 10%, more than 10% upside in the next 12 months. Okay. Shanghai Composite Index currently is trading around 2,350. You see the uptrend, recent uptrend. Our 12-month target is 2,540. Okay. Hang Seng Index, the PE band now is about 11 times. So last 2 years, actually it fluctuates between 8 times to 12 to 13 times. This band, PE band. So now it has come down again below the green. This is -1 standard deviation. So if it's -1 standard deviation, that means the market is already cheap. -2 standard deviation is very cheap, but that doesn't happen very often. Only happened once after the financial crisis, that because of fear, people dump stocks, so the valuation drops to, I think that time was 7 times. That's -2 standard deviation. Okay. The Hang Seng Index is still clearly in an uptrend. This is a rising channel trending up. So if it does not breach the support of this support level, that would be around 22,400 or 22,300. So that would be a key support. Recently, it dropped to 22,550, 22,550, and then rebounded to 235.0. Now, of course, with this US fall overnight, today I think it will drop below 23,000 again. So you can observe, see it can hold above 22,300. That would be the key support. But the uptrend is still intact. And one healthy thing is you see the high, the yearly high is trending up. The yearly high this year so far is 25,353. Last year is only 24,200. So we saw a clearly uptrend. For the next 12 months, our target is 26,600. 26,600. Okay. One last chart. Gaming stocks have dropped a lot. I'm not sure if your clients have bought a lot of gaming stocks. So what should we do, what's our view on the gaming stocks? This is the monthly gross revenue from Games of Fortune. Is released by the Macau gaming regulator. So this is, you look at this, you are very happy every month. Up 25% year on year. 13, 17, 21, 31%, 21, 18% year on year. But that was 2013. That was 2013. How did it fare? 2014. Okay, this is 2014. You see, start to record negative growth since June. Down 3.7%. July was down 3.6% year on year. August down 6.1%. September was even worse, down 11.7% year on year. So the share price, the drop in the gaming stocks is actually related. It's not without reason. There's a reason, and the main reason is the revenue has come down. Very simple reason. The gaming revenue has come down. And why? You may wish to ask why it came down, dropped 4 months in a row. I think it's due to two major reasons. First, the Chinese economy has slowed down, so it affected tourist arrival and also the gaming revenue. Secondly, you may be aware this cramp down on corruption by Xi Jinping. So a lot of the high-ranking officials have remained low profile. But people ask if this is affected by any change in the policy, China policy, visa policy. I can tell you there's no change in the visa policy so far. No change. That means now Chinese visitors, they can go to Macau on this free visitation scheme, 自由行, 6 times a year. So there's no change. They have not reduced the frequencies of Chinese visitors. It's more organic type of change because the economy, the macro economy has slowed down, and those who can, the VIP, those gamblers, frequent gamblers are the corrupt officials. Now they are being arrested. So less supply It's very simple, supply and demand. Less supply of gamblers, of high rollers to Macau. So I think this will last for a while. This will not see a short-term improvement because you look at last year's high. The highest was October. So October last year was the best month they have recorded. This is the record revenue for Macau so far in Macau's gaming history. 36.4 billion. That's a 36.4 billion Macau dollar. 36. That's about 66 billion Sing dollar. 6 billion Sing dollar a month. So much. Yes, that's every month. So much. And so much. That's the money lost to the casinos. Okay. Despite the fall, you say so much. Despite the fall, now every month the gaming industry in Macau, despite the fall, they are still getting more than 25 billion a month. About 4 billion Sing every month in revenue. That's huge. But the investor community, they don't like negative, they don't like drops. They always want increase. So the share price, say for instance, Galaxy dropped from more than above $80. Currently it's below $50. I think it's a reflection of the drop in the gaming revenues. So you look at here. Last year the highest was 30. October 36.4. So October figures have not released yet. This is Golden Week. I think it will be again very challenging for Macau this month because you have a high base figure last year. This month, if the figure came in at close to 30 billion, I think it would be quite good. But if it comes in 30 billion, it's still nearly 20% lower than last year because last year we got a very high base. So I think we need to wait for a few more months when the this year the first half maybe we need to wait until April, May next year when the base figure become lower. Then you will see growth again, positive growth again when the yearly figures for comparison become a low base again. And we still like Galaxy. I think don't need our recommendation now is no need to rush in. You can wait. But next year they are going to open a new casino, Macau Galaxy Phase 2. Between May and June. And then by that time, after the opening of a new casino and also the figures for comparison is much lower, then I think you'll see a comeback of the gaming stocks next year in the second half of next year. So maybe first half, February was very high again. So maybe it will experience another sell down when the February figures are released next year, because this year the February figures was the record high after October last year. Last year October the highest was 36 billion for 2013, but the highest this year was 38 billion. So February figures would be another reason or excuse for sell-off. But after that, I think we'll start to start climbing. So maybe between January and February, if there's a low entry point, you can recommend the gaming stocks. And out of the 6 gaming stocks in Hong Kong, we still prefer Galaxy because that will be the only gaming companies with new casinos to open next year. Okay, so that ends my presentation today. Hope you have happy trading with Shanghai Hong Kong Stock Connect. Okay, thank you.